Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. So this video will cover several questions from chapter 2, which deals with corporate formations and capital structure. So as we review chapter 2, we learned that when an entrepreneur decides to start a business, they have to decide whether or not they want to organize the business as a sole proprietorship, a partnership, a corporation, a limited liability company, or a limited liability partnership. So this chapter essentially delved into some of the advantages and the disadvantages for each form of business association. This chapter in particular focuses on corporations, a C corporation, and what some of the tax consequences are for incorporating a business. So this chapter, and as we go through some of the questions, we'll examine some of the tax implications of deciding to capitalize a corporation with equity and with debt, and also describing some of the advantages and the disadvantages of alternative capital structures. So one of the key things that we learned in chapter 2 is that sometimes unincorporated businesses like a sole proprietorship or a partnership, they can choose to be taxed as a partnership or a corporation under rules referred to as the check the box regulations, right? And some of the legal requirements as we see with essentially forming a corporation is that a corporation essentially dictates the legal requirements for forming a corporation. So this might include investing a minimum capital amount, filing articles of incorporation. They'll also have to issue stock, pay any necessary incorporation fees to the state or any other jurisdictions. So one of the key things that must be considered when forming a corporation is how are they going to transfer cash, property, maybe they're transferring equipment, furniture, receivables, maybe they're going to provide services to the corporation. These transfers may have tax consequences for both the transferor, which is the investor, and the transferee, which is the corporation. So in such case, before forming a corporation, there's some key things to consider. Some questions that you might ask yourself, or for those of you who do decide to venture into becoming a tax professional, your clients might ask you, what property should they transfer to the corporation? What services should they provide to the corporation? What liability should be transferred? Do the shareholders have control over the corporation? So those are some key things to keep in mind. So in order to help encourage forming corporations, we have what's called Section 351. So as we go through chapter 2, this will be our main focus for this chapter. Section 351, which is a provision of the Internal Revenue Code that allows transferors, those who are deciding to start a corporation, to defer gain or losses upon incorporation. So Section 351A provides that transferors recognize no gain or loss when they transfer property to a corporation solely in exchange for the corporation stock if immediately after the exchange, the transferors are in control of the corporation. So Section 351, just keep in mind, it doesn't apply to transfer of property to an investment company, and it doesn't apply in certain bankruptcy cases. And just keep in mind, for Section 351, it does not need to be a new corporation. This rule also applies to existing corporations. So the specific requirements for deferral of gain or loss are 3 requirements. First, the transferors must transfer property to the corporation. 2, they must receive stock of the transferee corporation in exchange for their property. And 3, they must be in control of the corporation immediately after the exchange. So as we go through each question, we will explain each requirement in a bit more detail. So here we see, in which of the following independent situations is the Section 351 control requirement met? So here we see Olive transfers property to Quick Corporation for 75% of Quick stock, and Mary provides services to Quick for the remaining 25% of Quick stock. So as it relates to the property requirement, this is the first requirement for Section 351, and the rule of gain or loss non-recognition applies only to transfers of property to a corporation in exchange for the corporation stock. So as it relates to Section 351, it doesn't define the term property. However, the courts and the IRS, they've defined property to include cash and almost any other asset. So this includes inventory, accounts receivable, equipment, patents. This also includes intangible assets. So just a quick sidebar. Intangible assets are assets that you cannot see, touch, or feel. However, it has value. So an example might be a trademark or a patent or goodwill versus a tangible asset, one that you can see, touch, and feel, such as an automobile or a building. So just keep that in mind. Property includes both tangible and intangible assets. However, excluded from the statutory definition of property are services. So if a shareholder contributes legal or accounting services in exchange for the stock, that is excluded. There is a caveat, which I'll explain in a few. If there's any indebtedness of the transferee corporation that's not evidenced by a security, or if there's any interest on the transferee corporation debt that was accrued either on or after the beginning of the transferor's holding period for the debt, right? So the IRS wants to ensure that people are not essentially taking advantage of the tax law in burden. So when it relates to transferring services, there is a caveat as mentioned. If a person transfers both services and property to a corporation in exchange for the corporation stock, all the stock received by that person, including the stock that they received in exchange for the services, is counted toward the 80% control threshold. So when this person transfers both property and services in exchange for the corporation stock, the property that's contributed, whether it is cash, if it is a building, equipment, the property contributed must have more than a nominal value for that person's stock to count towards the 80% control threshold. So simply stated, according to the IRS and the advanced ruling, the stock received for property to be more than nominal value is if it is at least 10% of the value received for services provided. All right, so in that case, if the stock received for the property is essentially not equivalent to 10% of the value of the stock received for services provided, then unfortunately, their ownership does not count towards the 80% requirement. So just keep that in mind. So here we see Olive transfers property to Quick Corporation for 75%, and Mary provides services for the remaining 25%. So nowhere in this does it say that Mary also provided services. So we covered what it means to, contribute property. In addition, we need to understand what it means to have control of the company. So as it relates to having control of the company, it is considered 80%. They need to own at least 80% of the company. So Section 351 requires the transferors as a group to be in control of the transferee corporation immediately after the exchange. And the transferor, it can be an individual or it can be a type of entity. It could be a partnership, it could be another corporation, it could even be a trust. So Section 368C defines control as ownership of at least 80% of the total combined voting power of all classes of stock entitled to vote, and at least 80% of the total number of shares of all other classes of stock. So just keep that in mind. So 80% is that key percentage. So in this case, Olive only owns 75%. Mary provided services, and because she only contributed services, the control is not met in scenario A. So for scenario B, we see Pete transfers property to Target Corporation for 60% of Target stock, and Robert transfers property worth $15,000 and performs services worth $25,000 for the remaining 40% of Target stock. So in this case, we essentially see that Robert contributed both property as well as services. So this is one of those caveats where the individual transferred both services and property. So therefore, In such case, we need to account for the property and the services that were performed. So in such case, we see Pete transferred this property for 60% and Robert transferred property worth $15,000. So therefore, if we look at the share requirements, the value of the stock received for services was 25,000. So 25,000 multiplied by 10%. 10% of the value for the stock received for services is 2,500. So therefore, the property that was contributed by Robert must have been 10% of the stock received for services or more. So in this case, Robert contributed property that's worth 15,000. So it's well above the 10% threshold mark. So therefore, the entire 40% of Robert's ownership counts. So therefore, control is met in this case. For C, we see Herb and his wife Wilma each have owned 50% of the 100 outstanding shares of Vast Corporation stock since it was formed 3 years ago. In the current year, their son Sam transfers property to Vast for 50 newly issued shares of Vast stock. So based on this information, initially there were 100 outstanding shares. Sam transferred 50, he transferred property for 50 new shares. So in total, now there's 150 shares outstanding. The 100 that Herb and Wilma owned, and now the additional 50 that their son Sam now owns. So Sam's ownership is as follows: 50 divided by 150, he only owns 33% of the corporation. So therefore, the control is not met in scenario C. In scenario D, we see Charles and Ruth develop a plan to form Tiny Corporation. On June 3rd of this year, Charles transfers property worth $50,000 for 50 shares of Tiny stock. Assume the same facts. On August 1st, Ruth transfers $50,000 cash for 50 shares of Tiny stock. So here we see in this case, they decided to, transfer property. Charles transferred property, and then on August 1st, Ruth transferred additional property. So in such case, just because there's a delay in timing, it does not necessarily mean that Section 351 is not met. So in this case, Charles contributed property and Ruth contributed property in the form of cash. So control is met in this case. They essentially had a pre-arranged plan. It says that they developed the plan to form this corporation. And about 2 months later, Ruth made a transfer of her contribution. So for E, we say, assume the same facts as in part D, except that Charles has a pre-arranged plan to sell 30 of his shares to Sam on October 1st. So in such a case like this, these are the things that Uncle Sam, the IRS, wants to avoid, whereby people are intentionally trying to take advantage of the tax law. So because Charles already pre-planned to sell some of the stock, control would not be met in this case. And both Charles, in this case, he will have to recognize the gain on the property that he transferred. So just some key things to go over as it relates to Section 351. There's 3 specific requirements for the deferral of gain and loss. The first is that the transferors must transfer property to the corporation. Property is essentially cash and almost any other asset. Services are excluded from the statutory definition of property. However, there is a caveat. Whenever a person transfers both services and property, all of the stock received, including the stock received in exchange for services, it will be counted towards the 80% control threshold if the property that the individual contributes is more than 10% of the value of the stock received for the services provided. So that's the first requirement. The second requirement is that the transferors, they must have ownership of at least 80% of the total combined voting power of all classes of stock entitled to vote. And at least 80% of the total number of shares of all other classes of stock. And this is governed by Section 368C. And lastly, they must receive stock of the transferee corporation in exchange for their property. So they must only receive stock. In the event that they receive something in addition to stock, so let's say they receive stock and then they also receive, let's say cash, or they also receive property or something of that nature, in such case, then there's something recognized as boot, and then a portion of their transfer might be subjected to tax. All right, so this brings us to our next question. So here it asks us, the following tax consequences for the transferor if Section 351 applies. So it states, what are the tax consequences for the transferor? Remember, the transferor is the investor, the shareholder, and the transferee represents the corporation. When property is transferred to a newly created corporation in an exchange, qualifying as non-taxable under Section 351. So here we have the following tax consequences for the transferor if Section 351 applies. So there's essentially three requirements that apply to both the transferor as well as the transferee. So we'll go through each one by one. So here we see for A, the basis of the stock received equals the adjusted basis of the property transferred plus any gain recognized by the transferor minus the fair market value of any boot property received minus any money received, including liabilities assumed or acquired by the transferee corporations. All right, so A is correct. And when we go through one of the practical questions where we actually have to apply some of the information to determine if Section 351 applies or not, we'll get a greater understanding of how the basis of stock is calculated for the transferor. But for B, it states that transferors recognize no gain or loss when they exchange property for stock, including any non-cash property received. The character of the gain does not depend on the type of property transferred. So B is incorrect. Transferors recognize no gain or loss when those three requirements are met. When they essentially transfer property to the corporation, when they are in control of the corporation, which is at least 80%, and when the transferor receives stock in exchange for the property. So B is incorrect. C states transferors recognize no gain or loss when they exchange property for stock. And it says exception, a transferor recognizes gain equal to the lesser of the realized gain or the sum of money received plus the fair market value of any non-cash property received. The character of the gain depends on the type of property transfer. So this is correct because, again, in the case that the individual receives stock and a note, or stock and cash, or stock and property, a portion of it might have to be recognized because they received something in addition to the stock. Here we see the holding period rather of stock received in exchange for capital assets or Section 1231 property includes the holding period of the transferred property. The holding period of stock received in exchange for any other property begins the day after the exchange. All right, so this D, so here we have the holding period is the stock received in exchange for capital assets or Section 1231. So it does include it. So next we see the basis of the stock received equals any gain recognized by the transferor minus the adjusted basis of the property transferred plus the fair market value of any boot received minus any money acquired. So that is incorrect. As we pointed out, the basis equals the adjusted basis of the property plus any gain minus any liabilities or money received. So E is incorrect. Then for F, we have the holding period of the stock received in exchange for capital assets or Section 1231 property includes the holding period of the transferred property. The holding period of stock received in exchange for any other property begins on the day of the exchange. But in such case, it begins the day after the exchange. So these are just some key things to keep in mind. There's 3 tax consequences for the transferor as mentioned, and the same applies for the transferee, the corporation. So here it states, a corporation recognizes no gain or loss when it exchanges its own stock for property or services. So this is correct. B, it states the corporation's holding period for property received does not include the transferor's holding period. This is incorrect. It does include the transferor's holding period. So B is incorrect. C, it states a corporation recognizes gain and loss when it exchanges its own stock for property and services. C is incorrect. D states the corporation's holding period for property received includes the transferor's holding period. So D is correct. E states the corporation's basis in property received is the transferee's basis plus any gain recognized by the transferee. So this is incorrect. It's saying the transferee. Remember, the transferee is the corporation. So F is the correct answer. The corporation's basis in the property received is the transferor, the shareholder's basis, plus any gain recognized by the transferor. However, if the total adjusted basis of all transferred property exceeds the total fair market value of the property, the total basis to the transferee is limited to the property's total fair market value. All right, so this brings us to the third question. So keep in mind, this relates to the control requirement. So there are certain situations whereby an individual, they can do some tax planning to ensure that they meet the 80% requirement. So here we see how many additional shares must Sabrina receive in exchange for the bullion to avoid recognizing a gain? What value of silver bullion should she contribute to stand up in exchange for additional shares? So here we see Matthew and Sabrina own 200 and 180 shares respectively of stand-up corporation stock, which represent all the shares outstanding. So in total, there's 380 shares outstanding. The current market value per share is 30. Stand-up needs capital to expand its operations, and Sabrina is willing to contribute to stand-up silver bullion against which the corporation can borrow operating funds. Sabrina purchased the bullion 12 years ago when its cost was a fraction of the current market value. So if Sabrina wants to avoid recognizing a gain upon transferring the bullion to a corporation, how many additional shares must she receive in exchange for the bullion? And what value of silver bullion should she contribute to stand up in exchange for additional shares? So we know the 80% requirement. She needs to achieve the 80% control of the corporation. So we have our Excel spreadsheet so we can work through the information to determine all right, so here we see, in order to determine the additional shares that are needed, we need to do the following calculation. We need to determine the shares that are owned, and we're trying to determine A, And we need to divide it by the total shares plus the additional amount that needs to be contributed. So in such cases, we review. We see that the current shares owned by Matthew are 200 shares plus A, we need to figure out A, divided by the total shares. Well, in this case, we're solving for Sabrina, my apologies. So Sabrina owns 180 shares. So keep in mind, Matthew owns 200 shares and Sabrina owns 180 shares. So the shares owned by Sabrina, so I'll just input that information, Sabrina. So we're looking at it for Sabrina. So Sabrina owns 180 shares, divide plus A. And then from there, we determine the total shares. That lets us know Matthew owns 200, Sabrina owns 180. So there's a total of 380 shares plus A. And this information is essentially going to give us 80%. So we need to look at this information to determine the 80% equals 0.8. So we essentially factor out this information. So we have 180 plus A equals 0.80%. And then we multiply it by 380 plus A. So we're essentially breaking down a formula pretty much. All right. And now for the next step is for us to essentially multiply. And again, we're breaking down a formula. So step by step. So we start off with 180 plus A divided by 380 plus A equals 80%. So this is essentially our formula that we start off with. 180 plus A divided by 380 plus A equals 80%. And then the next part of the formula is 180 plus A equals 80% multiplied by 380 plus A. The next part of the formula now is 180 plus A. And we essentially factor it out. We multiply the 380 by 80% plus 0.80. And then the next part of the step is we ultimately need to determine the total amount. So here we have 180 positive, and keep in mind, we are trying to get A by itself. So here we see we have 180, so we essentially combine a like term. So we have 180 plus A equals 304 plus 80A. And keep in mind, we're trying to get the A to itself, so we're basically going back to algebra. So I will annotate. So we see the like terms, we see the 180 and the 304. So we have a positive 180, and we essentially want to get the A by itself. So what we will need to do is subtract 180 from both sides to get the number by itself. And then we have 1A, and then we have 0.80A. So in order for us to get the A by ourselves, by itself, we essentially need to subtract 0.80A from both sides, and then we need to subtract 180 from both sides. So in such case, we minus 180, minus 180. So that gives us 304 minus 180. And then from there, we have 1A, or 1 minus point A, which gives us 20%. All right, we'll just do the simple math. So we know 1 minus 0.8, so it'll be 0.20 A. So in order for us to determine, again, we're trying to get A by itself, we would essentially need to divide both sides by 0.20. So therefore, in order to determine the additional amount of shares, it would be 124 divided by 0.20. So therefore, the total shares needed would be 620 shares. All right, so we essentially have to do some algebra. So again, here's the calculation up above. I'll go over it quickly. In order to determine the additional shares needed, it represents A. And remember, she wants to meet the 80% control requirement. So Sabrina owns 180 shares. So 180 plus A divided by the total shares owned plus A equals 80%. So we had 180 plus A. And from there equals 80% of 380 plus A. And then from there, the next step was essentially 180 plus A. And here we did the calculation. And from there, we had 180 plus A equals 304. We essentially multiply the total shares owned by 80%. And then we essentially distributed it. So we multiplied the 80% by 380, and we multiplied the 80% by A. So that is how we have 304 and 88. And then from there, we had 180 plus A equals 304 plus 88, and we are combining like terms. We have a positive 180 on the left. We want to get the A by itself. So we subtracted 180 from both sides. And then we have a positive 1A, and we have a 0.88. So we subtracted the 80A from the positive 1A. So that is how we got 0.20A equals 124. And in order for us to get A by itself, we needed to divide both sides by 20. So therefore 0.20. So we found our answer by dividing the number of shares by 20%. So based on this information, the value of the shares, it lets us know in this problem is $30 per share. The total shares, as we've calculated up above, is 620. So therefore, the value that needs to be contributed is 30 multiplied by 620. So therefore, the value to contribute is 18,600. So Sabrina needs to purchase an additional 620 shares, and the value of the silver bullion that she should contribute to stand up is 18,600. All right, so I know there was a lot going on in that problem, but just keep in mind you are essentially doing some algebra as you look at that problem. So this brings us to our next problem. So here in this problem, it asks us, we have 1, 2, 3, 4, 5, 6, 7 requirements. It's asking us what is the amount of recognized gain or loss, what is the basis in the shares, and they're asking this information for both the transferor, the shareholder, aka the investor, as well as the transferee, the corporation. So here we see for this question, it asks, in the current year, Dan, Pete, and Kerry form Hades Corporation. Dan contributes land, a capital asset having a $125,000 fair market value. So whenever you see FMV, that stands for fair market value, in exchange for 55 shares of Hades stock. He purchased the land 3 years ago for $140,000. Pete contributes machinery, section 1231 property purchased 4 years ago, having a $100,000 adjusted basis and a $75,000 fair market value, in exchange for 45 shares of Haiti stock. Kerry contributed services worth $50,000 in exchange for 10 shares of Haiti stock. So we look at this information. We want to determine what's the total amount of shares. So Dan owns 55 shares. Pete owns 45 shares. And then we see that Kerry also owns 10 shares. All right, so based on this information, we go through and it asks us, what is the amount of Dan's recognized gain or loss? So we look at the fair market value of the proceeds received. So in such case, contributed or the fair market value. And in such case, we're looking at Dan. So we'll start off with Dan. And the fair market value is $125,000. And the adjusted basis of the land, as it lets us know here, is $140,000. So based on this information for Dan, the fair market value of the property minus 140,000. So therefore, there's a realized gain of $15,000. And keep in mind, the realized gain is not necessarily the recognized gain. So realized is the amount, the economic position, but the recognized amount is the amount that is actually reported on the tax return. So just keep that in mind. So in such case, they have a loss and the loss is not reported. So in such case for Dan realizes a $15,000 loss and he recognizes no gain or loss. Oh, sorry about that. All right. And now the next part of the question is essentially asking, what is Dan's basis in his Haiti share? And when does his holding period begin? So as it deals with the stock basis calculation, this is how we determine the amount for the transfer reward. So we start off with the adjusted basis of the property transferred to the corporation. So in this case, the adjusted basis of the property transferred is $140,000. We would add any gain recognized by the transferor. We would subtract any boot other than money received for the corporation. This is zero in this case, there's no gain recognized. We would subtract the boot. All he received was the stock. He didn't receive any money from the corporation and there was no liability assumed. So therefore, Dan's basis would be $140,000. And his holding period for the stock would begin 3 years ago when he first purchased the land. So now we move on to Pete. So for Pete, here we see the fair market value of the proceeds received for the corporation. The fair market value we see here was $75,000. and the adjusted basis of the machinery was 100,000. So based on this information for Pete, the fair market value of the proceeds minus the adjusted basis of the machinery, so therefore, Pete has a $25,000 loss. And much like Dan, he recognizes no gain or loss. And for Pete, the calculation is fairly similar. We would start off with the adjusted basis, and in this case, the adjusted basis is 100,000. There's no gain recognized by Pete. There's no boot. There's no money received, and the corporation did not assume any liability. So therefore, the adjusted basis of stock for Pete is 100,000, and his holding period begins 4 years ago when he purchased the machinery. This brings us to Carrie. So it asks us, how much income, if any, does Carrie recognize? So we see here that Carrie, she contributed services. It doesn't say anything about her also contributing property, so we don't need to factor in her percentage towards the control requirement because she only contributed services. So Carrie recognizes, in such case, a $50,000 gain, and she recognizes ordinary income of the $50,000, which represents the services that she provided and the stock that she received. So for requirement F, it asks us, what is Carrie's basis in her Hades shares and when does her holding period begin? So based on this information, again, Carrie contributed services. So her basis is 50,000, and her holding period begins the day after the exchange date in the current year. So for this next part of the problem is asking us, what is Hades' basis in the land and the machinery? When does its holding period begin? And how does Hades treat the amount paid to Carrie for her services? So we essentially looked at the basis and the recognized and realized gain for the transferee, the shareholders, and now we look at it for the corporation. So we start off with the transferor's adjusted basis in the property. So we start off with the land. So in such case, the land would be calculated as follows. We start off with the adjusted basis. So we'll start off with the land. We see that the adjusted basis was 140,000. The transferor did not recognize any gain. In this case, there was no reduction for the lost property. So therefore, the transferee's corporation basis in the land my apologies, 40. Whoop. So we have the transferor's adjusted basis in property. There was no gain. However, they did have a reduction for the lost property. So as we see, the fair market value was 125,000. And then they purchased the land for 140,000. So there was a $15,000 reduction for the lost property. So therefore, Hades' basis in the land is 125,000, and it includes Dan's holding period. And now we look at Hades' basis in the machinery. So the adjusted basis for Pete, as it lets us know here, was $100,000. And the reduction for the lost property, the fair market value was 75,000, and the adjusted basis was 100,000. So therefore, the corporation Hades' basis in the machinery is 75,000, and it includes Pete's holding period. And this brings us to the last part of the question. It asks, determine how Hades will treat the amount paid to Carrie for her services. So Hades' basis in the services would be, again, they paid her $50,000. And if the services were capitalized, they would start in the current year. So capitalized basically means that the payment is being deducted over a number of years versus it being expensed when it is just being taken in the first year. So this is our answer for the last part of the question. All right, so I know there was a lot going on with that question. Hopefully, as we went through it. And again, a lot of the things are theoretical. And then as we go through some of the homework problems, hopefully the practical application will start to make a bit more sense. So here we have our next question. And it's asking, what is the amount of Jerry's recognized gain or loss? So we're going to work with a problem where the corporation assumes the liability of a transferor, so that way we can get a better understanding of how it has an impact on the basis and the recognized gain or loss for both the transferor as well as the transferee. So here we see Jerry transfers to Emerald Corporation property having a $32,000 adjusted basis and a $50,000 fair market value in exchange for all of Emerald's stock worth $15,000. Emerald's assumption of a $35,000 mortgage on the property. So we read through the requirements. We have 4 requirements. What is the amount of Jerry's recognized gain or loss? What is Jerry's basis in the Emerald stock? What is Emerald's basis in the property? And how would your answers to part A through C change if the mortgage assumed by Emerald were $15,000 and the Emerald stock were worth $35,000? So we start off with our first requirement. The requirement A, it's essentially asking us to determine the realized gain or loss as well as the recognized gain. So we start off with requirement A. We consider the fair market value of the stock received. So in such case, the fair market value of the stock that we received, as it lets us know, in exchange for stock worth $15,000. So the fair market value of the stock is $15,000. The liability that was transferred, it lets us know here that Emerald assumed $35,000 mortgage on the property. And then we need to subtract the basis of the property transferred. So it lets us know that the property has a $32,000 adjusted basis. So therefore, in order to determine the realized gain or loss, it is the fair market value of the stock received plus the liability transferred minus the basis of the property. So based on this information, Jerry's realized gain or loss in this case is $18,000. The next part of the problem is asking us, well, what is the recognized gain? So in this case, we are dealing with a liability that was essentially transferred. So when we're dealing with the liability that was transferred, there are some additional things that we need to factor in if there's an assumption of liability. So whenever a shareholder transfers property to a controlled corporation, sometimes they assume that the transferor's liability, as did in this case. So the question arises as to whether the transferee, the corporation's assumption of the liabilities, if it's equivalent to a cash or a boot payment. So we need to essentially determine the impact that it would have on the individual. So there's what's called Section 357, and Section 357 helps to kind of provide relief from such treatment. So under the general rule for Section 357A, for the purpose of determining a gain recognition, the transferee's corporation of liabilities in a property transfer that qualifies under Section 351 is not considered equivalent to the transferor's receipt of money, right? But there's 2 exceptions. In the event that, the transfer has a purpose of avoiding tax, and when the transfer of liabilities assumed by the corporation exceeds the total basis of the property received. So in such case, Emerald assumed $35,000 worth of liability, and the adjusted basis is $32,000. So therefore, based on this information, Section 357 does not qualify. So therefore, the difference between the two is going to be treated as a recognized gain. So here we see the liability transferred is $35,000. The basis of the property transferred is $32,000. So therefore, the recognized gain is going to be $3,000. So for requirement B, it asks, what is Jerry's basis in the Emerald stock? So obviously this has an impact. So we start off with the adjusted basis of the property transferred to the corporation, which we know is $32,000. We have to add any gain that's recognized by the transferor. In this case, he had a recognized gain of $3,000. And from there, we factored in the liabilities assumed by the corporation, which was $35,000. So when we factor this in, the $32,000 plus $3,000 minus the $35,000 for the liabilities assumed, the adjusted basis of stock is 0. And let's just say that the liabilities assumed were more, the basis can never go before 0. So just keep that in mind. So for requirement C, it's essentially asking us, what is Emerald's basis in the property? So what is the corporation's basis in the property? So we start off with the adjusted basis in the property that was transferred, which we know was $32,000. We add any gain recognized by the transferor. In this case, Jerry had to recognize $3,000. So therefore, the transferee's basis, the corporation's basis, is $35,000. For requirement D, it asks, how would your answers to part A through C change if the mortgage assumed by Emerald were $15,000 and the Emerald stock were worth $35,000? So based on this, new fact pattern, we need to factor in, okay, so the adjusted basis of the property transferred to the corporation, and what amount would be Jerry's recognized gain or loss? So in this case, his liability does not exceed the adjusted basis. So in this case, the mortgage assumed was only $15,000. The basis was $32,000. So Jerry would recognize no gain or no loss, right? Now the fact pattern changes. Now for B, we need to factor in what is his basis in the stock. So the adjusted basis of the property transferred is $32,000. The liabilities assumed are $15,000. So therefore, his adjusted basis in the stock would be the $32,000 minus the liabilities assumed. Jerry's basis in the Emerald stock would be $17,000. And now for the last part of the question, it asks, what is Emerald's basis, the transferee corporation's basis in the property? So the transferor's adjusted basis, as we know, was $32,000. Jerry did not recognize any gain, so therefore the transferee's basis in the property is $32,000. So I know there's a lot of information going on in this problem, but the key thing to essentially keep in mind is that with the general rule of section 357A, for purpose of determining the gain recognition, the transferee corporation's assumption of liabilities in a property transfer that qualifies under section 351, it's not considered equivalent to the transferor's receipt of money. However, this rule has two exceptions. The first exception is if the transferor's purpose is simply to avoid tax and there's no bona fide business purpose. And the second is whenever the transferors, the liabilities that are assumed by the corporation, if it exceeds the total basis of the property transferred. So in the first scenario, he transferred property that had an adjusted basis of $32,000 and the liability assumed was $35,000. So therefore, it did not meet the requirements. So he had to recognize a $3,000 gain versus in the scenario in D, where the mortgage assumed was only $15,000 and the basis was $32,000. And this is why Jerry recognized no gain or loss. All right, so this brings us to our last question. And this is dealing with section 1244. So one of the key things is that sometimes stock may become worthless, right? This is essentially something to keep in mind. So anytime investors, they purchase stock in or they lend money to a corporation, they do it because they want to earn a profit, or at the very least, they want to recover their investments. But we know that, the markets can be volatile. So sometimes investments, they don't offer an adequate return on capital. And sometimes the investors, they lose part or they lose all of their investment, right? So in the event that this happens, then the investor, they essentially have securities that become worthless. So we have what's called section 1244. So anytime a debt or equity security rather becomes worthless, it results in a capital loss for the investor, right? And in such case, we have something called section 1244 stock. So under section 1244, it's a provision that helps taxpayers. So under section 1244, it permits shareholders to claim an ordinary loss if qualifying stock that were issued by a small business corporation is sold, exchanged, or it becomes worthless. Keep in mind, this treatment is available only when an individual, the person who received the qualifying stock, was a partner in the partnership at the time they acquired the qualifying stock. So just keep that in mind. The original person needs to, claim the loss. And one of the key things is that capital losses, as you would have learned in federal income tax 1, is that capital losses, they are subjected to a $3,000 maximum loss claim per year. If you're married filing separate, then the maximum amount is $1,500. So if you have a $9,000 loss, if you are any other filing status other than married filing separate, it will take you 3 years to write off that loss, $3,000 per year. If you were married filing separate, then it would take you 6 years. Versus if you had an ordinary loss, you can claim that $9,000 loss, the entire amount in the year when it took place. So there are some benefits to having capital gains, but there's a disadvantage of having a capital loss. There is a disadvantage of having an ordinary gain, but there are benefits of having an ordinary loss. So the principal advantage of satisfying the section 1244 small business stock requirements is the ordinary loss treatment. So this treatment is available. There's 4 requirements that must be met. And if the issuing corporation derived more than 80% of its aggregate gross receipts from active sources during the most recent 5 tax years ending before the date when the stock was sold or exchanged, this is incorrect. The correct answer is that 50% of its aggregate gross receipts during the most recent 5 years. So A is incorrect. B, if the corporation issued the stock for money or property, this is a requirement. If at least 50% of the aggregate gross receipts of the lost corporation for all years were derived from non-passive income sources, this is incorrect. Only if the loss is incurred by a qualifying shareholder who acquired the stock from the small business corporation, this is correct, has to be incurred by a qualifying shareholder. It cannot be if they receive the stock from inheritance, they receive it as a gift, or from another shareholder. It has to be the qualifying shareholder, the individual who first acquired the stock. If the corporation was a small business corporation at the time that it issued the stock, that is a requirement. Only if the loss is incurred by a qualifying shareholder who acquired the stock from inheritance, stock as a gift, or purchase. So as mentioned, that is not a requirement. They have to be the qualifying shareholder who originally acquired the stock. And G, if the issuing corporation derived more than 50% of its aggregate gross receipts from active sources during the most recent 5 tax years. So G is the correct answer. All right, so that brings us to the end of our questions for chapter 2, which covers corporate formation and capital structures. So again, the main thing that was covered in this chapter is section 351, which is essentially learning objective 3. And I know there's a lot to cover with this section. There's a lot of nuance, but I trust that as we continue to go through some of the homework problems and as you read through the theory and apply it practically, it'll all start to make sense.